This should be a very interesting discussion and video article. The evolution of the greater digital economy, and specifically the digital asset economy, is constant. New developments happen monthly, and every quarter the blockchain ecosystem becomes more and more productive. Different perspectives and insights are drawn while the market cap of Bitcoin continues to stay healthy. But what does productivity and stock to flow have in common with Bitcoin? Well, a lot actually, and here's why. First, stock to flow provides a framework for the price of the asset. Opinion, mine only. Second, productivity is an intrinsic value assessment of what Bitcoin is. Again, opinion, mine only. Combining these two frameworks can help build a wider understanding of the asset. Gold has been and will continue to be a store of value, but humanity's ingenuity has created a viable alternative. The limited supply of 21 million Bitcoin is quite unique as well. Bitcoin has enormous advantage in terms of the network effect that a viable alternative will likely not take hold within the population. So scarcity can be quantified by stock to flow. Stock is the size of the existing stockpiles or reserve. Flow is the yearly production. Instead of stock to flow, people also use supply growth rate instead. So what is it? Stock to flow is a framework and a financial model typically applied to commodities. PlanB, an anonymous internet persona, is the founder of Bitcoin's stock to flow model and cross-asset model. The thesis is grounded in the supply design of the asset, as scarcity drives value. Gold has the highest stock to flow, as it takes 62 years of production to get the current gold stock. Silver is second with a stock to flow of 22. This high stock to flow makes them monetary goods. Bitcoin currently has a stock of about 17.5 million coins and a supply of about 0.7 million coins a year with a stock to flow of 25. This places Bitcoin in the same category as monetary goods like silver and gold. Bitcoin's market value at current prices is over $70 billion. After reading PlanB's analysis in his modeling Bitcoin's value with scarcity article, stock to flow is perfectly suited for guiding supply side economics for commodities. Please read his article in depth for a full analysis. Bitcoin has attributes of currency-like functions and store of value. Therefore, stock to flow model can be applied. As a digital asset, this is a game changer for humanity. PlanB claims after the May 2020 halving, the market value of Bitcoin could run up to $1 trillion or about $55,000 per Bitcoin. So therefore, read Coin and Token Quarterly today to get the latest insight on Bitcoin's price movement and to protect your portfolio. Download and subscribe Coin and Token today. An alternative view and goal to disprove the stock to flow model comes from Charlie Morris. Morris is the co-founder and CIO of ByteTree, a cryptocurrency data provider for institutional clients. According to the Cointelegraph article, a researcher debunks stock to flow model likens Bitcoin to a tech stock. The author, who I assume read and paid for the institutional report, says Morris believes Bitcoin's price is not dictated by supply-side economics. Critically, Morris does have a point. Any holder of the asset is free to sell at once, which could lead to a cratering price. The supply of Bitcoin will trickle down ever more slowly, and the role of miners will continue to diminish. Miners will still play a vital role in maintaining the ecosystem, but just won't be the net sellers of coins, as they are only about 1.7% of the current market cap. Additionally, the intrinsic value of Bitcoin boils down to its usability and adoption. Usability and adoption. Morris makes the claim that usability and adoption are the best metrics for an intrinsic value assessment of the asset. Morris makes a solid claim. let's take a step back and look at Bitcoin ecosystem from 30,000 feet. Miners, hodlers, exchanges, payment processing, unit of account, and store of value are some of the big use cases that Bitcoin can fulfill. The second key criteria being the adoption of the asset. Just because you can build it and satisfy a need does not mean the adoption will be quick. Many new and leading edge technologies take years or even decades to be fully integrated into society. For example, look at the period between 2000 and 2020, specifically with internet usage. In the early 2000s, the internet was just beginning to take hold in everyday life, but was still reserved for clunky desktop computers and slow bandwidth nationwide. Now, in 2020, if your business does not have a digital presence, they will not make it. Bandwidth and the advancement of smartphone technology are rendering new business models. The world is trending to smartphones, fast, highly networked digital communities, and 5G. All of the previously mentioned items are primarily for retail customers. Let us turn our attention to institutional use cases in practice today. Probably the most head-turning development so far has been the custody services of Bitcoin via asset management firms. Let's take Fidelity, for example, in their subsidiary, Fidelity Digital Assets. Fidelity is one of the world's largest asset managers with over $1 trillion in assets under management. Other major obstacles are the restrictions that many funds have and the ability to allocate into the asset via their mandate. This is precisely where the major problem is and the major artery to development. The digital asset management ecosystem could benefit from a sounder public relations and education strategy to accelerate adoption. Trade associations need to take more proactive approaches, not just with regulators, but asset managers as well. The next decade will see an ironing out of a lot of fundamental speculation within the asset class. Until then, stay tuned and download Coin and Token magazine today to get the latest insight on Bitcoin's price movement to protect your portfolio. Stay tuned.